I'm gonna record this. Okay, we're going to start this now. Assume that Maurer Enterprises retires its computer printers, which cost the company $40,000. Okay. The accumulated depreciation. So I want you to take a note here. Take a note and make me 2 T accounts, one for equipment and one for accumulated depreciation. Okay. Maurer Enterprise retires its printers, which cost $40,000. The accumulated depreciation on these printers is also $40,000. What is the journal entry to record this retirement? Okay. So you have to get the balance out of equipment. You have to get the balance out of accumulated depreciation. And they both have the same balance, 40,000. So what's the debit? What's the credit here? Put it in the chat. You want to get rid of a piece of equipment. Julie, debit equipment, credit accumulated depreciation. We're not buying the asset. Oh, some debit accumulated depreciation, credit printing equipment. Okay, that is correct, Zamzam. Micah, no. Okay, let's think about this. You've already bought it. You've been using it. So when you purchase the equipment, you would have debited equipment, credited cash. Now you're retiring it 5, 7, 10 years later. So you've got a T account with equipment balance debit. Now we got to get it out of that T account and make it go to 0. So we are.
So it's like closing entries, basically, where you like
exactly. Reverse. Yes,
okay.
It's very much like closing entries. So we're saying we want to retire this asset. We are no longer using it. It's old. It's done. Debit accumulated depreciation, credit printing equipment. And that's a perfect world where you didn't have any salvage value. Everything's done. You just quietly retire the asset. Okay. What happens? So I want you to visualize those T accounts. Can I do this? Let's just change this. So in this case, I'm just going to put the ending balances here. We have equipment and we have, and I'm not going to worry about depreciation expense right now because I'm going to assume depreciation expense is all caught up, but I'm not going to track that. So we have balance here, balance here. Let's fix this. We have a $40,000 balance in equipment and a debit, and we have a $40,000 balance credit and accumulated depreciation. I want to retire this asset. To do it, I need a journal entry that gets it to go to 0. Okay. Let's do this minus some. Okay. Okay. After I make that journal entry, there'll be 0. So really, really use your T accounts to help you on these problems. Okay. Okay. What happens if it's fully depreciated plant asset is still useful to the company? What are you going to do then? Then you're just going to leave it. You're not going to make this journal entry will go away. You won't have it. You'll just have a debit 40 in equipment and a credit 40 in accumulated depreciation. All right. Oops. All right. So now we're at the top of page 37. And now we're going to do an early retirement. Assume that Maurer Enterprises retires its computer printers, which cost, oops, let's get the right one. I'm reading the wrong problem. Assume that after booking the journal entry for depreciation expense, Morales Company discards delivery equipment. with an original cost of 19,000. And again, you're on page 37, so just create little T accounts there somewhere on that page. So equipment had an original cost of 19,000. And its accumulated depreciation is 14,000. Okay. So do the easy part first. Empty out accumulated depreciation, empty out the equipment account. So how do you do that? What's the debit? What's the credit for those two accounts? We're not done with the journal entry, but for those two accounts, what's the debit? What's the credit? So in this case, it's going to be 19,000 and 14,000. Okay, what's the journal entry to get these out of here? We're not done with the journal entry, but give me those two accounts. What are they going to, what are they going to do on the journal entry? Alexis, good. Okay, so Alexis is saying you got to clear them out. So we're going to debit accumulated depreciation. We're going to credit equipment. We know these don't balance, okay? They're going to be off by $5,000, but that's building that's how we build the journal entry. Okay, so to make this journal entry balance, we need a debit of 5,000. Okay, so when you need an amount to balance, it's either going to be a debit or a credit. In this case, it's a debit because we didn't get any cash when we got rid of this asset. All right, so if it's a debit, it's going to be a loss on disposal. Losses are expenses. Expenses, normal balance, are debits. So are losses. So if you need a debit to balance, you have a loss on disposal. Okay. So write that journal entry in. And in the homework, I think it said loss on plant disposal. I think that's the language it used. Something like that. Plant asset disposal or something goofy like that. But I'd like just.
Oh, sorry, can you go back real quick? I wasn't able to copy it.
Oh, sorry. Did it go away? There. I was just adding that. Okay. So no matter what, when you retire an asset, you should be able to get the accumulated depreciation is a debit, delivery equipment or equipment is a credit. That part should be easy. And then whatever's left over, you use it to balance. Okay. Now it's really important here that you understand that right here, these words are really, really, really important. Let me just. Okay. Typically, a problem will say to you, they sold the asset mid-year, and then you have to do two journal entries, one to book depreciation as of the disposal date, and then two to book the disposal journal entry. Okay. All right. So what happens? So let's go to the middle of the page. What happens when you sell a plant asset? Okay. So first thing you do is you have to record that cash came in. You got money for something, so you're going to debit cash. Okay. And then you do the same thing. You empty out accumulated depreciation, you empty out the equipment account, and then you say, did we have a gain or a loss on that disposal? Okay. But I'm going to give you a problem where you have to catch up depreciation first. So let's do that first. So bottom of the page, Wilbur Company, page 37. Okay. So assume on July 1st, Wilbur Company sells office furniture for 16,000 cash. So we're going to assume this is a plant asset, that their job is not selling furniture, but they're just selling off some office furniture. The office furniture originally cost 60,000. as of now, dates are really, really important. So circle the dates in this problem. This event happened, this sale happened July 1st. The office furniture originally cost $60,000. As of January 1st, its accumulated depreciation was $41,000. Okay, so let's take a quick peek at some T accounts. So we're going to get rid of these guys. We're going to say the equipment account had 60,000 and accumulated depreciation had 41,000. Okay, but that was at the beginning of the year. Okay, and we're making this sale on July 1st. Okay, so step one, catch up depreciation as of the disposal date. In this problem, they are giving us that amount. In some problems, you have to calculate that amount. Okay, so this problem is being kind. Depreciation is 8,000 for the first 6 months. So your first journal entry on page 37 at the bottom is book depreciation expense through the disposal date. We have to catch it up. Okay, so you know the journal entry, debit depreciation expense, credit accumulated depreciation, and then the dollar amount. So go ahead and write this one in there if you haven't already. All right. And these two entries are happening one right after the other. We catch up the depreciation as of the disposal date, and then we dispose of the asset. But before we do that, I want to go back to those T accounts. Okay, so now we booked as of the disposal date. I'm not going to worry about numbers here. We booked the current year's depreciation, and we're booking. Okay, so now the balance in accumulated depreciation is higher. Okay, so pay attention to that, 60 and 49. All right. So we're going to say, you can do this calculation at the top or not. You really don't have to. So let's just book the journal entry. We sold, let's go back, hold on, sorry. We sold it for 16,000 cash. So we want to recognize the cash coming in. There's the cash coming in, debit. There's accumulated depreciation being emptied out, and that's a debit. We've got to empty out office equipment for the full 60,000. Now stop here and see if your journal entry adds up. Remember, debits have to equal credits. Right now we have 60,000 on the credit side. How much do we have on the debit side? Oops, sorry guys. I'm playing around with the numbers. What's the total on the debit side? Put it in the chat. So we've got 60 on the credit side. How much do we have on the debit side? Total dollars, 65,000, good. So we don't balance 65,000 on the debit side, 60,000 on the credit side. We need 5,000 more credit. And there you got it. Gain on disposal of plant assets. Why is it a gain? Because it's a credit. Credit gains are like revenue. Losses are like expense. Normal balance for revenue, credit. Normal balance for expenses, debit. So you basically get these three guys up, these three accounts up, and then if you need a credit to balance, it's a gain. If you need a debit to balance, it's a loss. Okay, let's do a loss on disposal. Let's see. I don't think I gave you a spot for it. You're going to have to just squeeze it in. Okay. So assume instead of selling the equipment for 16, they only sold it for 9. So you'd build that same journal entry, 60 on the right, but now we only have what, 58 on the left. So we have to put 2 as a debit here, and that's going to be a loss on sale. You guys with me?
Yes.
Thanks, Julie. All right. You don't really need to do this calculation up here. It's just sort of a double check. You can do it all in the journal entry. All right. So for tax purposes, you can have two sets of books, one for your SEC reporting, one for the IRS. Okay. The IRS does permit different depreciation methods on your tax return from what you have on the financial statements. And the IRS has its own rules about what depreciation methods you can use. Straight line or something called MACRS, Modified Accelerated Cost Recovery System. Okay. But GAAP is how we do our financial statements when we prepare them for analysis and submit them to the SEC. All right. Revisions in depreciation. So I want to talk about that in theory, and then we'll hit that more on Friday. I want to give you a few minutes in your groups to do breakout. Okay. So anytime we change depreciation methods, we do it on a go forward basis. It's not considered an error. And so we say, hey, we thought that truck had a 5-year life, but it's looking like it's going to have a 6-year life, or it's looking like it's going to have a 4-year life. You don't go back and reissue a bunch of statements. You just do it forward. Okay. All right. So let's stop here. I'm going to stop sharing. And I would like you to go into your breakout rooms, but let me get out of here. And I want to put up your rooms again real quick so that you can remember what team you're on. Okay, so we started out this class by sharing that I've put you guys all onto teams. So remember what team you're on. So I've given you company assignments, and I just want to do a quick check-in with all the teams. And we will be working on, your first part of this project will be to get your individual financial statements. Do not share them. You're going